This idea of using gold and stablecoin to kind of reshuffle the deck chairs on the Titanic, debase the dollar significantly, then bring it with the gold valuation, because we've seen from Besant and the Fed papers that came out in August and July, they're slow dripping us, getting us ready for the possibility.
You're watching Silver News Daily. Subscribe for more.
The world is standing on the edge of a financial event so massive, it could reset everything we know about money. Behind closed doors, the Federal Reserve is panicking. And now, for the first time in over 50 years, serious discussions are emerging at the highest levels about a full-scale dollar reset. But this time, the plan is more dangerous than anything we've seen before. A hidden strategy involving gold revaluation and stablecoins is quietly being put into place. And if it goes through, it won't just impact the rich. It could wipe out the life savings of millions of ordinary people overnight. But here's where it gets explosive. While the mainstream media fixates on stock markets and election drama, something much bigger is happening beneath the surface. Gold is rising, yes. But silver? Silver is the wild card, the underdog. And it's quietly positioning itself to be the biggest winner of this entire monetary upheaval. Not because of hype, but because the math, the history, and the market signals are all pointing to a coming surge that could send silver to levels no one is ready for. What happens if the dollar is deliberately devalued? What if gold is revalued to $10,000, $20,000, even $50,000 an ounce? And what does that mean for silver? Trading today at a fraction of that price? The answer isn't just shocking, it's inevitable. Stay with me, because by the end of this, you'll see why the Fed's next move could ignite a silver supernova that redefines wealth in the 21st century.
T-bills is really the best form of collateral in the markets. There's a massive scramble for T-bills. So one of the things I always have in the back of my mind is, how relevant really is this? It certainly is relevant for the markets and it's relevant for politics. But in a certain way, as of now, I'm not even sure I really am worried about whether we go up or down 25 bips. It's really what's the trend going forward. And the trend for Powell going forward is more cuts to come. And that's where it gets interesting. But again, what I think was really more fascinating is what he did after the cuts, because the cuts were relatively, as I said, predictable. Last year, he said that labor resilience was the thing. The whole theme is the labor markets are great. But now with this BLS downward revision, he basically said in his press conference that was a mistake. His old speak was a mistake. And, this 925,000, labor revision, he also said, that's the biggest ever. But he also says we kind of expected this. So my reaction to this, like many others, is, well, what does he mean by that? Were you guessing last year or were you just lying? And since the Fed is all about data dependence, but you're basically saying you don't trust your data. The data is not reliable. He even said about forecasts that they don't really know. So again, what's the point of your data and data dependency if you don't really trust your data, or you're not telling us you trust your data? And what's the point of your forecasts if we don't really know? And the other thing he took a jab, as you mentioned, there's this kind of Cold War between Powell and Trump. Trump has called him a loser, a moron in tweets. That's classic Trump speak. Some people love it. Some people hate it. It's very blunt. But Powell had his own way of basically saying that tariffs are causing some of the price inflation, and that the foreigners aren't really, who are exporting to the U.S. aren't reducing their prices. So the American importers are the ones swallowing these higher tariffs, these higher costs. And that's Powell's way of taking a dig at Trump, because if the importers, if the U.S. companies are taking the heat and swallowing the tariffs, that means they're going to have to raise their prices. That's inflationary, and they're going to probably lay off people. That's employment related. So Powell's basically blaming some of the employment and some of the inflation on Trump, which, fine, we can argue about tariffs all day long, and we've done it many times. But what's really disingenuous about that, and I think in Powell's mind, very disingenuous to me, is he's ignoring decades of monetary and fiscal drunk driving by the Fed, by Congress, and by other White Houses before Trump. Bernanke, expanded the balance sheet by $2.5 trillion in 5 years, and Powell did $5 trillion in 18 months. So if you're going to talk about inflation, you want to pick on Trump's tariffs, there's room for that academically, intellectually. But come on, Powell, you're part of this Fed. You're part of this great beast, this creature from Jekyll Island. You are part of the problem for inflation that goes back decades. So I thought that
if gold is the anchor of a collapsing monetary system, then silver is the fuse, waiting to ignite. And in any serious gold revaluation, silver doesn't just tag along. It explodes. Let's break this down. Right now, the gold to silver ratio sits around an 88 to 1. Wow. That means it takes 88 ounces of silver to equal the value of 1 ounce of gold. Historically, that number is way out of line. Over the last century, the average ratio has hovered closer to 47 to 1. Go back further, and you'll find eras where it traded near 15 to 1 and even 12 to 1 in ancient times. So if gold suddenly revalues, say, to $10,000 an ounce, that same 88 to 1 ratio would suggest silver shoots to $113 per ounce. But here's the twist. Revaluations always come with ratio corrections. In every major monetary reset in modern history, the gold-silver ratio collapses. And when it does, silver outperforms gold, massively. Why? Because silver has something gold doesn't: accessibility. A middle-class family might never afford an ounce of gold at $10,000. But silver? That's where they'll go. It becomes the poor man's gold. And in times of monetary chaos, demand doesn't just rise, it detonates. What we're looking at isn't some fringe theory. It's a mathematically obvious outcome of a gold reset. When gold gets repriced to absorb massive debt loads, silver gets dragged up with it, and then catapults beyond anyone's expectations. And we're already seeing the pressure build. Central banks are stacking gold at record pace, hinting at a shift in monetary backing. Meanwhile, silver remains artificially cheap. That disconnect is unsustainable. If gold doubles, triples, or even quintuples as part of a financial reset, silver could jump tenfold or more. Not just to $50, but to $100. $150 or even $200 per ounce. The ratio would demand it. And that's not a fantasy. That's just history doing what it always does.
There's so much to pull on, and there's so many themes to start with. But it is the most recent headline. It's worth talking about these rate cuts, which were really so priced in. I mean, the whole market, the whole world saw this rate cut coming, and what really it is. I mean, most listeners probably know it was a 25 basis point rate cut. Again, that was more than 95% of the market saw that coming. It lowers the Fed funds rates to 4 and 25 bips or 4 and a quarter. So that's what happened. What does it mean? What were confessed? What's the reality behind it? It's a little more interesting. As always with the Fed, what they say, what they're doing, and what's really happening are very, very different things. I think it was, besides just the cut itself and the implications of that, which we can get into, I think some of the things that Powell was saying in the Q&A after were very telling. The one thing is he was using words like trajectory that the Fed is on, which basically in my mind is, a very dovish signal. There could be more cuts to come. So he's building expectations for this. So if we don't cut rates again 2 or 3 times, or at least 2 times this year, the markets will react. It's almost if there was a rate hike. So that was an interesting indication in the Q&A. He's building expectations to stimulate this economy. And he also basically said that 25 basis points won't do it to make the stimulus. So those are kind of some initial reads I got from Powell just in watching his Powell speak or Fed speak. I mean, the official read from the Fed, whether it's Powell or Bernanke or Greenspan or Yellen, the markets and the reactions are so Pavlovian now. Rates are up or down depending on which is a greater threat, inflation or employment or unemployment. So if there's an inflation fear, it's usually rates up. If there's an employment fear, it's usually rates down. And obviously, with the BLS, many people may or may not know, there was a massive downgrade in the non-farm payroll jobs just last week. And it's the greatest downgrade in its history. It was a downward revision of 925,000 jobs. I mean, that's worse than we saw in 2009 after the great financial crisis. So obviously unemployment was Powell's on his mind to justify what is necessary in a labor crisis is a dovish lower rate policy, which is exactly what we got. Again, the reality to me, inflation, deflation, employment, et cetera, rates up or down. The reality, the Fed's real mandate, yes, it's employment and fighting inflation, but its real mandate is a sovereign bond market. And the real question is, do cuts even matter right now? I mean, in a lot of ways, the Fed and what we're seeing, the Fed is a lame duck. Whether we raise rates or not, the T-bill market is still below the Fed funds rate. And short-term,
The U.S. national debt is now over $37 trillion, and the government's only remaining option is the one nobody dares speak aloud. Inflated away. That means devaluation, on purpose. The Fed can't say it outright, but their actions scream it. Quietly, deliberately, they're cornering themselves into a policy of controlled currency destruction. It's what economists call a constructive default. You don't miss a payment. You just pay back your debt with dollars that are worth dramatically less. And this is where silver enters the picture, not as a speculation, but as a lifeline. Here's the reality. Every rate cut, every stimulus program, every new treasury auction is just a step closer to the point where confidence in the dollar begins to fracture. And when that moment comes, capital won't sit still. It will flee fiat assets like treasuries and bonds and pour into hard assets, especially gold and silver. But here's what makes silver so dangerous to the status quo. It doesn't just benefit from monetary debasement. It exposes it. Because unlike gold, silver is a working metal. It doesn't just sit in vaults. It gets consumed, demanded, and depleted. This is why the Fed's desperation is so bullish for silver. When they slash rates and pump liquidity, they're not stimulating growth. They're destroying real yields and lighting a fire under tangible assets. Today, the real yield on 10-year treasuries is negative when adjusted for actual inflation. That means savers are guaranteed to lose money. Meanwhile, silver, scarce, indestructible, and universally recognized, is becoming one of the only hedges left that hasn't already been priced for panic. And when this reset accelerates, the window to act will slam shut. Because as the dollar burns and gold gets revalued to absorb global debt, silver won't wait politely. It will do what it always does. It will slingshot into motion, turning from ignored to indispensable almost overnight.
I think it was dishonest. And this dishonesty is, again, one of the symptoms of a debt-sick nation. We've seen other forms of dishonesty since then. The modern monetary theory, this idea you can print money, unlimited money, and not have inflation. And we can go into that for hours, but that's clearly a fantasy. That's a lie. The idea that inflation is temporary or transitory, that we can control it like a thermostat, that's been a lie for the last 50 years. Recently in 2022, when we were in a recession, in my opinion, we're still in a recession. We changed the rule of what a recession is. That was a lie. For the last 25 years, the RIA industrial complex and private wealth managers from every major bank have been telling investors that gold is too volatile. That was a lie. It was a deliberate lie. Gold's outperformed the S&P in the last 25 years. So one of the big consequences, not just currency debasement, is dishonesty. And I think the third consequence is really desperation. And we see that in the headlines all over the place right now. The idea, and again, you could pick any one of these threads later, Elijah, but the obvious signs of desperation is that tariffs are going to save us, or that stablecoin is going to save us, or that cutting spending at Doge or US aid is going to save us, or even more terrifying, that AI is going to save us. And even desperate things like the constant talk now of gold revaluation. This asset they once made fun of for decades is now our savior. So those are the signs of desperation. Again, we could spend time on any one of those topics, but the symptoms that the jig is now up, that the lie is up, again, those things are literally everywhere. All things that you and I have talked about and others have talked about, the symptoms are clear. De-dollarization is not a conspiracy theory or a false headline. It's a real force right now. The debate about the dollar and the DXY, which I've had with Henrik Sieberg and Brent Johnson, the DXY's moved down, and where it goes from here. These are symptoms that the jig is up. You know, the QE and the stock bubble, the fact that we've inflated the stock market to unfathomable levels directly correlated to money printing from the Fed. That's just another symbol or symptom that the jig is up. The deformed nature of our credit market. No one is buying U.S. treasuries. That's a reality. Why? Because we're in so much debt, it's less trusted. We weaponize it, it's even less trusted. So that's another symptom that the jig is up. What we've seen in the COMEX, what you and I have talked about, the pure panic on the COMEX, where counterparties want their gold off the COMEX, no longer price fixing gold through levered futures contracts. That's another rabbit hole we could spend hours on. Central bank gold stacking tripled since 2022 because we weaponized the dollar. That's an obvious U.S. Treasury replacement. Gold is clearly the new central kind of strategic reserve asset for the world. We saw the trend of dumping treasuries and buying gold since 2014. The world's been net stacking gold, net dumping treasuries. It's just accelerated. So that's another sign. The petrodollar, 20% of oil being sold outside the US dollar. That was
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
Behind the curtain of this looming monetary reset lies a modern deception: stablecoins. On the surface, they look like innovation. Digital dollars that promise stability, instant settlement, and financial freedom. But behind the marketing sheen is a Trojan horse. Stablecoins aren't here to preserve purchasing power. They're here to absorb debt, soak up excess treasuries, and buy time for a dying fiat system. And when the revaluation switch flips, anyone holding digital dollars will be left holding a bag of melting ice. Let's break it down. Tether alone now holds over $90 billion in U.S. treasuries, making it one of the largest buyers of American debt. That's not a coincidence. It's part of a strategy. As confidence in traditional buyers like China and Japan wanes, these private digital entities pick up the slack, creating a new synthetic demand for the dollar. But here's the trick. They're programmable. They're trackable, and they're designed to be switched out at a moment's notice. If a devaluation event occurs, if the Fed revalues gold to $10,000 or more to erase debt, the dollar's value plunges. And stablecoins? They get hit instantly. Physical assets like silver, on the other hand, don't get reprogrammed. They can't be digitally diluted. And this is exactly what happened in 1933 when the US government confiscated gold and then revalued it higher. Anyone holding paper dollars lost. Anyone holding the metal won. Today's setup is eerily similar. The only difference? This time, it's not paper. It's digital. This is why silver is more than just a commodity right now. It's a financial firewall. While stablecoins lull millions into a false sense of safety, silver stands outside the system. It's untracked, unmanipulated by code, and immune to a midnight policy shift. And in a world where the next devaluation could happen with a line of code, that kind of independence could be priceless.
Absolutely, this is no coincidence. The DXY is struggling, de-dollarization is happening, and gold is reaching all-time highs. This is nothing new in the cycles of credit cycles throughout history, whether it's ancient Rome, whether it's Weimar Germany, Yugoslavia in the 1990s, France in 1789, the John Law era of 1720. This is nothing new. And we're getting distracted on a lot of different headlines right now. But I think it's important for a couple minutes to put all this into some context. Really put this into context, and then you can pull any string you want. But again, these are all things you and I have talked about, Elijah, over the many years. But I think it's time now to just pause and look at this. Look, the elephant in the room is debt. And we've talked about that upside down and backwards. And we all know the debt is extraordinary. The debt to GDP, the 37 trillion and climbing, the deficit ratios, et cetera. We don't need to get into the details. But the problem is debt. And the cause is very simple. In August 15th of 1971, Nixon got off the gold standard. Why? Because we were in debt. He was facing re-election. And when you have a gold anchor to your currency, you can't create more of it. You can't create more debt to pay for it with debased dollars if you've got a gold chaperone. So what did he do? He took away the gold chaperone. Why did he do that? Very simple. It's the self-interest of politicians. Getting elected requires money. Staying elected requires more money. You need to do spending. You need to get popular. You need to get power. Gold was an anchor to preventing you from doing that. By getting off the gold standard, that gave the self-interest of Nixon, like all politicians before and since, more power to create more deficits and then pay for that or monetize that deficit with greater credit expansion and Fed money printing. So that's the philosophical reason. That's the cause. The problem was the debt. The cause was we got off the gold standard, we could do even more debt. So the first consequence of that, again, this is at 30,000 feet, the first consequence of that is clearly currency debasement. And we've seen that since 1971 in empirical objective forms. The second consequence of that debt crisis, that debt cancer, is dishonesty. I mean, dishonesty started the day we got off the gold standard when Nixon said this would be temporary and don't worry, your dollar will be worth just as much tomorrow as it is today. Well, it's 54 years later. We're still off the gold standard. It wasn't temporary. And measured against gold, your dollar's lost 99% since 1971. The other thing, it wasn't just Nixon in 1971 in August. It was the months before that. The then Fed chairman and the then Treasury Secretary was making the rounds of Congress saying, this gold chaperone, this gold standard is bad for us. In fact, it's holding the dollar back. The dollar's going to get stronger. Of course, that was a lie. And more importantly, they said gold is going to get lower once we get off the gold standard. And since 1971, gold has gone up 8,000% since 1971. So literally every single thing pre and post that policy was dishonest and not just wrong.
The calmest surface often hides the most violent undercurrents, and nowhere is that more true than the COMEX silver market. For decades, the silver price has been held in check by paper contracts, futures, options, synthetic derivatives that outnumber actual physical ounces by orders of magnitude. But now, that system is cracking. Inventories are plunging, premiums are rising, and the demand for real deliverable metal is surging. Something is happening on the inside, and it smells like panic. Right now, COMEX silver inventories are down 70% from their 2020 levels. That's not a dip, that's a drain. Institutional players and high net worth individuals aren't just buying exposure, they're demanding delivery. That's never been normal. It signals a growing distrust in the entire paper-silver system. When people want metal in hand instead of promises on paper, you know confidence is breaking. And in a market where the physical supply is so thin, it doesn't take much to trigger a squeeze. Meanwhile, massive short positions still sit like powder kegs on the books of major banks. Over 200 million ounces in naked shorts, with fewer and fewer real ounces available to back them. If too many investors demand delivery at once, those shorts can't cover. And that's when silver goes vertical. We've seen echoes of this before. The Hunt brothers in 1980, the mini squeeze of 2021. But this time, it's different. This time, the drivers are not just retail traders. They're sovereign wealth funds, hedge funds, and billionaires who understand the coming currency devaluation. Add to that the rising premiums on physical silver, up to $2.50 per ounce above spot, and you start to see what's really happening. There's a growing separation between the paper price and the real-world value of silver. And as the trust in COMEX contracts collapses, that divergence could explode into full-blown price discovery, where silver is no longer priced by algorithms, but by who actually owns it and who can actually deliver it. In that moment, the price suppression ends. And the real price of silver? It won't be decided in a spreadsheet. It'll be decided by who has the metal and who doesn't.
In a lot of ways, the U.S. has already defaulted on its debt. But in terms of this rate cut that kind of ended up, I mean, the markets, what that impact is going to be on the markets, we're all kind of predicting, but it's not that hard to predict. Obviously, with rates coming down, the interest rates going down, it's going to have an effect on the dollar, longer term, weaker dollar, longer term, gold at near all-time highs at the announcement. Gold secular going to go higher. I think with more rate cuts to come this year, we'll probably reach 4,000 gold before the end of the year, just because the dollar and the DXY are going to have fluctuations based on this policy move. And even silver, which pulled back a couple bucks, look, it's going to hit 50 soon. That's at least a 20% return just now if you're buying silver. But if you're buying it for the long term, silver's going to go much higher. The GEX is going to go higher. The long end of the yield curve is probably going to see rising yields and bond prices going down. But, the larger question is, the Fed still effective? And, look, do cuts even work? In 2001, Bush, the DXI went from 108 to 121. The dollar got stronger while Greenspan was slashing rates. So the real question is, at what point does the Fed become less and less powerful? And at what point does the bond market take over natural price discovery? At what point do whatever the Fed does to manipulate rates up or down or to try and save the U.S. Treasury market, which is its real mandate, at what point did the bond vigilantes come in and bond prices continue to tank? The Fed can't print enough money to support them. Yields spike, and at $37 trillion in debt right now, rising yields will be the coup de grace for the U.S. system. And that's where we're dangerously in trouble. And that's where I think the larger questions of what's really wrong with the U.S. system and this massive implosion moment we're facing, and we're already in a lot of ways. And I think the rate hike announcement, sure, we got to talk about it, but it reads the larger question of how effective even is the Fed anymore? The political infighting, the blaming on inflation, the back and forth, it's all just smoke and mirrors, because the real problem is we have a debt crisis, and the causes of it are obvious, the consequences are obvious, and the solutions for it aren't that easy.
While the monetary side of silver is grabbing headlines, there's another force building quietly, relentlessly, and it's sound industrial demand. In 2025 alone, over 59% of all silver consumed will go into industries that don't care about price. They just need the metal. Solar panels, electric vehicles, AI infrastructure, medical tech, advanced computing. These sectors are swallowing silver at a pace the supply chain can't keep up with. And here's the key. They're not buying silver as an investment. They're buying it as a necessity. Solar PV alone now accounts for 17% of global silver demand. As the energy transition accelerates, those numbers aren't going down, they're going vertical. EV batteries? Some now use nearly a full kilogram of silver per pack, and with China and Europe pushing electrification at all costs, there's no slowing down. Even AI data centers, the backbone of our future digital economy, are devouring silver for wiring and high conductivity components. The result? Structural deficits that no amount of investor selling can fix. This is what makes silver unlike any other precious metal. Gold sits in vaults. Silver gets used, and once it's embedded in tech, it's gone. Not recycled, not reclaimed. Gone. That means every year, the industrial world erodes the available supply just to function. And now, with supply already struggling to grow, we're entering a phase where the floor on silver's price is being set by industry, not investors. Think about that. Even if Wall Street ignores silver, even if retail investors stay distracted by crypto and tech stocks, the solar panels keep getting built. The EVs keep rolling off the assembly line. The AI chips keep shipping. And every single one of them needs more silver than last year. This isn't speculation. This is math. And when that unstoppable industrial demand collides with monetary chaos, the pressure will be too much to contain. Silver won't just rise. It will be forced higher by a world that can't function without it.
That was very disingenuous. But, again, when you're looking at Powell and these kind of lame duck figureheads who have a lot of credibility and a lot of academic credibility and political power, the disconnect between their messaging and their actual power, to me, is getting more and more obvious. They're becoming less and less effective. Today inflation is in the mid threes. We've been talking about reaching target 2% for years. It's never happened. What's the point of this target? And Powell said in this press conference that we'll probably get to that target 2% inflation rate in 2 years. Well, he said that exact same thing 2 years ago. And of course, we're avoiding the real elephant in the room, that inflation is measured by the Bureau of Labor Statistics, the CPI scale. It is an open lie. It's an open fiction. John Williams and others, and the same scale that Volcker used to measure inflation at 18% in the 80s, that same scale has been modified 22 times since then. But if we use that same scale, we'd have inflation at 10% or 11% right now. And before you just say, okay, great, that's showing how disingenuous or not really blunt Powell is, the bigger issue, besides the CPI scale being a lie and not being able to reach 2% inflation and blaming Trump for the tariffs and not blaming the beast that is the Fed, is the larger issue of what real inflation really means. And that's the biggest disingenuous lie of the whole thing. We're not even talking real data with this data-dependent Fed. We're not even talking real inflation numbers, because if you agree with me and John Williams and the old Volcker scale that we once used, if we have 10% inflation and we're getting 4% or 5%, or regardless of where you are on the yield curve, from the treasuries to the 30-year, every single U.S. treasury is a negative returning treasury, is a negative returning bond. You're losing 6 to 5% in real terms if you actually look at inflation the way it's meant to be measured, not the dishonest way it's measured now. So getting away from Powell and Trump, just looking at the bond market, the entire bond market is giving you a negative yield. And to me, constructively, when a bond gives you a negative return, that is definition a defaulting bond. So
On the other side of the equation, where price is set and availability is determined, stands the harsh truth about supply. It's not keeping up. Not even close. In fact, we're staring down a global silver supply chain that's shrinking, straining, and in some places outright breaking. For all the hype around digital finance and green technology, there's a silent bottleneck forming beneath it all. The world wants more silver than ever before, but the ground is giving up less. In 2025, total silver mine production is expected to come in at around 835 million ounces. That might sound like a lot, but it's actually flat compared to recent years, and she's down 7% from peak levels back in 2016. And here's the kicker. We're now running a projected odd deficit of nearly 118 million ounces for the year. That's a shortfall the size of entire national reserves every single year. And the deficit isn't just an abstract number. It's the reason premiums are rising, inventories are collapsing, and delivery delays are becoming the new normal. Mining isn't like flipping a switch. New projects take up years to bring online. And the ones that exist? They're battling declining ore grades, labor strikes, environmental pushback, and skyrocketing energy costs. In places like Mexico and Peru, two of the largest silver-producing nations, violence, regulation, and cartel disruption are squeezing output even further. There's no cavalry coming to rescue the supply side. If anything, it's retreating. Even recycling, once seen as a pressure release valve, can't keep up. In 2025, recycled silver will account for roughly 195 million ounces, but that's nowhere near enough to close the gap. Demand is growing faster than we can mine, process, or recover. And unlike other metals, there's no large-scale government stockpile to draw from. Once we hit the bottom of the barrel, that's it. This is why silver is entering a new pricing regime, not one based on speculation, but one based on scarcity. When the demand curve bends upward and the supply curve bends downward, there's only one place for price to go, and it won't wait for the Fed, Wall Street, or the media to catch up.
I think it's really important because, my business, our minimums are very high. Our clients are all high net worths, family offices, institutions. So why am I talking to you and why am I talking to the world? They're not going to be my clients. But Egon and I have always said it's not just, it's certainly not a fiduciary duty to us. It's a moral duty to try and educate, not just sell our book. And so we're saying you need to own gold as life insurance for openly dying currency. And so not so you can become a client of Von Grier's, because 99% of the people listening don't meet our minimums. But that doesn't stop us from every week, every day writing about this and talking about this so that the average citizen, the average middle-class American, of which I come from that world, lower middle class in the Midwest, I'm extremely conscious of this. So how do I get people to understand gold? And not look like I'm trying to make them a client or sell them a book or give them clickbait. It's a very important question. I think the first thing is, don't just take my word for it. Look at the math, not even the history. The history is kind of ornate and complex. You have to read a lot of books and look at different eras. Again, 18th century France, ancient Rome, Romania in the 90s, Weimar, Zimbabwe, the big examples. But there's literally tens of examples in these cycles of currency that's not money that gets debased because of extremely expensive governments that are over their skis in war debt or social contracts that they can't afford, and that they've debased their currency to pay. And throughout history, all paper money, as Voltaire says, goes to zero. That's a long history with a lot of examples. But just look at math then. Simple math, simple graphs. And if I had to say, there was a guy I used to know on Wall Street. He was at Goldman Sachs. He said, if you can't explain something with 3 graphs and a crayon, you're not doing anybody any service. So whether you're talking to very sophisticated people who work at, JP Morgan, you're talking to the guy on the street, whether you're a dental hygienist, a brain surgeon, a bricklayer, you can understand simple graphs. That's how I figured this out. And one simple graph is just to look at what the dollar has done in the last 54 years since we decoupled from gold versus gold. This is objective. It has lost 99%. So the dollar is this ice cube that you measure your wealth with. Whether it's in a checking account, whether it's in a portfolio, whether it's in a 401k, whether it's in your retirement account, you're measuring this in dollars. Or if you're in Europe, you're measuring in euros. Or if you're in Switzerland, you're measuring in francs. You're measuring it in paper money. And that paper money, that ice cube, is quantifiably, objectively melting versus gold, because gold's a better store of value. That should no longer be a gold bug selling your book clickbait story. That's just an objective fact. So you got to look at just the purchasing power of the major fiat money since 1971. All of them, from the Swiss franc to the euro to the dollar to the yen to the won, they're all losing money versus gold. Second thing, that is why central banks, and I'm not a fan of central banks. I'm not a fan of the BIS, the mother of all central banks. I'm certainly not a fan of the Fed, or even what's going on in the comics. But what are the big guys in the room, the insiders? I'm not saying the smart guys, but what are the insiders doing? The ones who actually caused this problem and are now benefiting from it. They're stacking gold. Why? Because it's shiny? Because they need more dental work done, or more wedding rings? No, they're stacking gold because they know what 99% of the retail audience has been misled about for the last 30 years by their advisors, that gold holds its value better than paper money. You won't get rich overnight, but you won't get gut punched by the invisible tax of inflation and currency debasement by owning a gram, an ounce, a bar of gold, whatever your income, if you can get some. And so it's because I don't trust government, I don't trust the honest.
While investors scramble to understand gold's resurgence, a far more subtle shift is unfolding. Central banks are beginning to eye silver. For years, gold has been the metal of choice for sovereign reserves. But as the dollar's dominance erodes and trust in the fiat system fractures, the question is quietly surfacing. Could silver be next? And if it is, we're talking about a redefinition of the global monetary game, one that most people aren't prepared for. The signs are subtle but unmistakable. Central banks purchased over 900 tons of gold in 2025 alone, continuing a multi-year trend of de-dollarization. But now, certain governments and supranational bodies are starting to classify silver as a strategic resource. The EU and China have already taken that step, explicitly linking silver to their energy security and digital infrastructure. That's a first. And it opens the door to something that just a few years ago would have been unthinkable: official silver reserves. Here's why that matters. If central banks begin accumulating silver, even at a fraction of their gold allocations, it will collapse the available supply. The physical silver market is tiny compared to gold. A few $1 billion is enough to move it. If even one major central bank decides to stockpile, it would send shockwaves through both the investment and industrial side of the market. And with sovereign actors stepping in, the game shifts from price speculation to strategic accumulation. This isn't about short-term trades. It's about positioning for a new monetary system, one where hard assets, not fiat promises, underwrite confidence. And silver, long ignored, suddenly becomes essential, not just for solar panels or EV batteries, but for national security, for reserve diversification, for survival in a world where the dollar is no longer king. So while Wall Street analysts debate rate cuts and inflation targets, the real players, the ones holding trillions, are moving. They've made gold the first move. If silver becomes the second, this market won't just double. It could detonate.
But this idea of using gold and stablecoin to kind of reshuffle the deck chairs on the Titanic, debase the dollar significantly, then bring it with the gold valuation, because we've seen from Besant and the Fed papers that came out in August and July, they're slow dripping us, getting us ready for the possibility of a gold revaluation. And again, the two steps is to devalue the dollar and the stablecoin, then revalue gold by tens of thousands. We did this in the 30s. Gold went from 20 to 35. There was a massive revaluation of the dollar. And we did this in the 70s. We wiped out about 40% of the US dollar's purchasing power within, the first 5 years. So We're as desperate now as we were under FDR, and certainly more so than we were under Nixon. So is this possible, this revaluation? And when I say revaluation, I'm not talking about revaluing our gold certificates at, $42.22 to spot. We're talking at a much higher level, creating a new floor in the gold price at tens of thousands of dollars higher. The problem with that too, and I'll end on this point, if we did revalue at a much higher level to bring debt to GDP down, it's effectively using gold for QE and debasing the dollar. Again, that's great for gold investors. That's brutal for anyone who doesn't have gold and owns dollars and measures their wealth in dollars. But even if we did that to solve our debt crisis at the expense of every citizen of the U.S. who doesn't own gold, every middle-class, hardworking American who can't afford a gram or an ounce of gold, they get clobbered. Nothing new there in the history of realpolitik. But then as a country, if we revalue gold higher, do you think it's going to be any different on the SPYMEX in St. Petersburg or the Shanghai Exchange? In other words, the whole world's going to revalue gold. And then you have the larger question of who really does have the most gold. And this is what Kissinger warned about in the 70s, because he knew what I think we all kind of know, that the World Gold Council's report on U.S. gold holdings is woefully inadequate, and that China probably has significantly more gold than the U.S. So that if we did revalue gold and he who has the most gold wins, China is going to have massive leverage in this new system, this new disorder to come out of the former U.S. dollar-led, world reserve currency-led hegemony and supremacy of the last 50 years. That's going to be a radical change. And yeah, will help us get out of debt, but we'll lose a lot of international leverage. We'll lose a lot of credibility, and we'll lose a ton of influence vis-a-vis China and Russia. I mean, Russia isn't even listed on the World Gold Council for how much gold they have. It's probably a lot more than the U.S. too. So these are a lot of things we got to think about as we're looking at fantasy solutions, whether it's gold revaluation, whether it's stablecoin, whether it's tariffs. There's nothing that easy, and there's nothing that doesn't end up with the dollar becoming less and less respected and the U.S. becoming less and less powerful. And we are going to get that because it's the karma of decades of living beyond our means, monetizing our debt with mouse click money, and spending like teenagers with their father's credit card at the mall. I mean, we as a country we are not going to be able to blame this on Trump. It goes back 50, 60 years of every policymaker, every Fed chairman, every president, red, blue, or center, who has been living beyond their means, getting power, spending what we don't have, and then making that delta filled with money that's clicked out of nowhere ex nihilo. That is criminal drunk driving at the policymaking level. And of course, the citizens are going to suffer for this.
Now let's confront the nuclear scenario, the one nobody dares price in, but everyone fears. A full-blown gold revaluation. Not just a rise in price, but a deliberate, calculated move by global powers to re-anchor currencies to gold at a dramatically higher level. And if that happens, the implications for silver are beyond explosive. They're historically unprecedented. Think about what a gold revaluation really means. It's not about market forces. It's about policy shock. It's what FDR did in 1933 when he seized the public's gold at $20.67 an ounce, then revalued it to $35. A stealth devaluation of the dollar by nearly 70%. In modern terms, that would be like the Fed waking up tomorrow and declaring gold to be worth $10,000, $20,000, even cheeky $50,000 an ounce. Not because the market demanded it, but because the debt crisis left no other way out. It's the monetary equivalent of pushing the reset button. So where does that leave silver? That's the key. The gold-to-silver ratio, currently hovering near 88-1, doesn't survive that kind of event. Historically, every gold revaluation tightens the ratio. At $10,000 gold and a conservative 60-1 ratio, silver would need to trade at $166 per ounce. At a 40-1 ratio, you're looking at $250 silver, sasa. And if we return to the historical norms of 15-1, that's over $650 an ounce. These aren't fantasy numbers. They're mathematical reflections of how revaluations work. Because when gold resets, silver doesn't just catch up, it overreacts. Its volatility turns a 2x gold move into a 5x silver move. And here's what makes that so dangerous for the establishment. Silver is affordable, accessible. A revaluation of gold would push the average investor straight into silver, creating a tsunami of demand in a market with no capacity to absorb it. This is why silver is the ultimate asymmetric play in a gold revaluation scenario. It's not just a hedge, it's a leveraged reaction to the collapse of monetary credibility. And if the dollar's final act is a repegging to hard assets, silver's repricing won't be linear. It'll be parabolic.
Look, it's like Michael Hartnett of B of A said, it's in some type of gold revaluation is inevitable. We have no choice. And that is somewhat tied to tokenization. So we can talk about both. I mean, look, there's a lot there because we are so desperate, because the dollar is so clearly unloved and unwanted, and the U.S. Treasury is so clearly, objectively, quantifiably in decline. So what do we do if we can't get people to buy our U.S. Treasuries and they're now selling them? And certainly if we're pushing tariffs on them, they're going to be less likely to buy our Treasuries. So we need some kind of demand for the dollar. In the stable coin, which is neither stable nor a coin, because a stable coin is a blockchain asset with these Bitcoin-like properties, or it's got this obviously blockchain technology for transfer speed, but it's really centralized by an issuer with an audited promise that one stable coin, $1 equals 1 unit that's redeemable. But the issuer here are fintechs like Tether and Circle Internet, or they're commercial banks like JP Morgan. So you invest your dollar with one of those issuers and you get an e-dollar back. You get a stable coin back. By the way, the issuers, fintechs, Tether, etc., take your dollar and then they invest it in treasuries to back the stable coin. So they get the yield on the treasury. They get an arbitrage spread. They're making billions. I mean, literally, Tether is making more now than Citibank. I mean, they're just doing so well on this. But the user, the end user, what do? You get a stable coin. You get no yield. It's not stable because it's backed by a U.S. Treasury. We've seen how the U.S. Treasury, whether it's in 2023 or 2022, can have 3 sigma moves. It can be volatile. It's the worst performing asset in the last 5 years. So you get a stable coin that's not stable. It's backed by U.S. Treasury. It can be, and it is, highly programmable, highly trackable, and like those truckers we saw in Canada during COVID, it's just as seizable. So it's very controllable, but the story is it's modern, it's tech, it's fast, it's liquid. That's the good side. The bad side is it is central bank digital currency, but instead of being issued by a central bank, it's issued by private fintech companies or commercial banks. But it's just as trackable and it's just as controllable as a CBDC. So it's CBDC by another name. But more importantly, for this revaluation scheme that the Russians are, whether you believe the Russians or not, it does make sense what they're saying, because stablecoin, is a new demand, is a new sponge for those dollars. And right now, stablecoin is the 18th largest buyer of U.S. debt. So it's very helpful. It's a win-win for Tether. It's a win-win for the U.S. Treasury. But think about it, go to the second or third derivative thinking. I'm not saying this is going to happen, but it's a very strong likelihood. And it's been done before. Like I said, under FDR and under Nixon, we can devalue the dollar and revalue gold. And what the Russians are saying and what this guy Anton is saying does make sense if you're cynical. But honestly, even if you're a realist like Michael Hartnett at B of A, it even makes sense to me that what you do is you put a ton of money into stable coins in this DLT technology, which Bitcoin kind of got us soft dripped and frog boiled to understand and get used to. It's a perfect psyop if you're doing this at ultimate cynic level, because you can fill a bunch of people into stable coins, and then the stable coin is very controllable. So then you can devalue the stable coin. And then you can basically, once you have a massive devaluation of the dollar to pay down some of your debts under the stablecoin mechanism, then you can revalue gold. And what the Russians are saying is the U.S. will revalue gold tens of thousands of dollars higher than it is today, which of course is great for me. I'm not just, for anyone who buys gold, that's great, but it's very, very bad for the U.S. dollar and anyone who measures their wealth in dollars. So I think that's the risk, and I think it could be done, and we'll see.
And hovering above it all like a ticking time bomb is the U.S. national debt, now at a staggering $37 trillion. This isn't just a fiscal problem, it's a monetary countdown. Because every trillion added without meaningful GDP growth pulls us closer to the one solution no government wants to admit: debase the currency or default. And history tells us they always choose the former. But while that might bail out the system, it destroys savers. It wipes out pensions, demolishes bond portfolios, and erodes every dollar-denominated asset the middle class depends on. This is why silver is no longer just a trade. It's a defensive shield. As real yields go negative and confidence in treasuries falters, capital is searching for alternatives. Bonds used to be the safe haven. Now they're a guaranteed loss. And in that vacuum, silver is emerging not just as a precious metal, but as a store of credibility. It doesn't rely on governments. It doesn't default. It doesn't require trust in a broken fiscal system. It simply is. And here's what's critical. We're not talking about a distant threat. We're already watching the consequences unfold. Treasury interest payments now consume nearly 1/5 of federal spending. The Fed is cornered. Cut rates and risk inflation, or hike and trigger a credit meltdown. Either path points to more printing, more erosion, and more demand for assets that can't be conjured out of thin air. That's why silver premiums are rising. That's why physical demand is outpacing supply. That's why ETFs are pulling in fresh capital. Because beneath the surface of every budget negotiation, every debt ceiling drama, every bland treasury auction, there's a growing realization. The dollar is being sacrificed to keep the machine running. And when that truth becomes obvious to the public, not just economists, silver's role will shift overnight. From an investment to a necessity.
Thinkable 5 years ago. These are symptoms, again, that the jig is up. Even Judy Shelton talking about a gold-backed treasury at the long end of the curve. That's not a confession of American strength. That's a confession that the American dollar and the U.S. Treasury isn't going to be trusted unless there's gold in it. So again, these things are all symptoms of those consequences, the dishonesty and the desperation, which is no longer working. And I think that God knows the global relations, Trump or no Trump, tariff or no tariff, they're the worst since 1949. Militarily, we have the biggest risk of nuclear war since the Cuban Missile Crisis. Within the U.S., the polarization left and right is murderous, literally on the headlines now. It's so violent. I see the same thing in Europe with coalition governments and the complete disconnect between the people and the leadership and the infighting socially and culturally. So those are all signs academically, historically, that I've been tracking now for 5 years that are really coming to roost now. And in terms of solutions, whether there's going to be no easy solution, whether we have some kind of global reset, a Bretton Woods 2.0 or a Plaza Accords. What we first need is honesty. Somebody has to get up and say, we are past the Rubicon of growing our way out of this debt. With 120, 125% debt to GDP, mathematically, debt stops you from growing. It slows growth by 1/3. That's just basic math and history. So we're not going to be able to grow our way out of this, period, until we bring our spending down. Our spending is mostly military and entitlements, and unless we do that, there is no solution, and I don't think we're going to do that. So we're going to have to inflate our way out of this debt. And there's talk of gold revaluation. You got this Russian guy, what's his name, Anton Kobayakov. He just came out a week ago and basically said the dollar, the Americans are going to do what they did in the 70s and in the 30s. They're going to devalue the dollar. They're going to shove everything into tokens and stable coins, and they're going to devalue stable coins. Instead of 1-to-1 ratio to the dollar, it's going to be 1 to a half a dollar. So the dollar's going to lose value overnight like it did in the 30s and the 70s, and then they're going to revalue with gold to tens of thousands. Is that possible? Is that what's going to happen? I don't know. But again, these are all desperate things happening now. The old system is objectively cracking. The consequences of the debt are obvious, and the symptoms that the jig is up are now obvious. This isn't even a gold bug argument anymore. This is something that the bond jocks that I know and the equity guys that I know and the currency and rate guys that I know are doing. And that's why gold is at all-time highs now. It's always getting the last silent laugh after being discredited for decades.
If you want to see where silver's headed, don't just watch the charts. Watch the central banks, the debt markets, and the bond traders. These are the pressure points of the system. And right now, they're flashing red. The US dollar is down 5% year over year. The Fed has pivoted back to rate cuts. And inflation, real inflation, not the massaged headline numbers, is running hot. The official CPI says 3.2%, but real-world costs? Closer to 8 to 10% depending on who you ask. That's a slow-motion default on every fixed-income portfolio in America. And it's pushing capital into places it normally doesn't go. Just look at silver's performance. It's not a fluke, it's a signal. This is what happens when the dollar loses credibility. Silver is responding not just to inflation expectations, but to a global search for monetary alternatives. BRICS nations are already dumping dollars and stacking gold. That's not politics, it's strategy. And behind the gold surge, silver is beginning to shadow the move, with even tighter supply and even more upside. Now, some might say the dollar is still strong compared to other currencies. That's missing the point. This isn't about relative strength. It's about absolute purchasing power. And the dollar has lost over 90% of its value since 1971. No matter how it compares to the euro or the yen, the dollar's trajectory is down. And in that world, silver isn't just an inflation hedge, it's a monetary counterpunch. So as central banks continue their silent rebellion, as governments inflate their debts away, and as real-world prices expose the fictions of official data, silver stands alone as both signal and solution. The more the dollar erodes, the louder silver speaks. And it's not whispering anymore. It's starting to roar.
Have to understand the math of what inflation is doing, what currency debasement is doing. It's not that gold's going to go up 25% and make you richer. Gold's going to hold its purchasing power more than that paper currency you measure your wealth with. And that is objective. I think it's mathematical. And again, no, most of you listening are not going to be a client of mine, but I'm very interested in you understanding these things because it's very unfair to me. It's always the middle class who get drafted. It's always the middle class who get shafted in an economic crisis. And it's especially dangerous for the middle class if they're older, if they're above 70 or 75, because people forget in markets that not every dip is a V-shaped recovery. Not every dip recovers in 2 months by the Fed. If you're over 70 and you're at the top of this market and we have a major mean reversion and you lose 30, 40, 50 or 50% or more, and you're older, you can't afford to wait 30 years like the Nikkei or 10 years like the Dow, the NASDAQ or the Dow after the 2000 crash to get that mean reversion back up. That's a very dangerous thing. And so these are the kind of things I think the man on the street isn't being told honestly, especially about market risk in the stock market. Because, these markets, the advisors don't tell you how long these valleys can last. This is something, that Jeremy Grantham taught me years ago when he was still trading. This was 15 years before he retired. But, these market troughs, they last 5, 6, 7, 10, 11 years. And then they spend the rest of the time, recovering, and then they rip again. But if we're at a market top now, maybe not the top, and then we have a mean reversion that can't be just central bank supported like we had in 2000, like we had in the great financial crisis, like we had in 72, these take years to recover. So that's another thing that people on the street have to ask their advisors. What if we don't get an instant mean reversion and I'm 75 years old and my 401k, which is worth X today, is worth X minus 40%? And then you tap on inflation to that. This is how the middle class is not being taught transparently about risk, not just currency risk, but about market risk and certainly about inflation risk. This whole thing with the Fed talking about 3% inflation, 2% inflation, fighting inflation, it's an absolute farce. And again, I'm a well-educated guy from Wall Street. I should be selling the book of how efficient markets are and how smart bankers are and how intelligent your leadership is. But left or right, most of them don't know history or economics at all in the White House, again, regardless of the party. And these central bankers have made a Faustian deal with themselves, like Greenspan himself, who once understood gold but stopped talking about it once they were elected. But you're not getting the truth about what inflation is doing to your wealth right now. And you're not getting the truth about market risk right now. And I think that is something it bothers me to the core, because again, I come from the Midwest, I come from the middle class, and I know most people aren't getting this information from their advisors. They're just not, and they're certainly not getting it from the mainstream media, the financial media at all.
So here's the bottom line. Silver's moment isn't coming, it's already here. The signs aren't subtle anymore, they're screaming. From collapsing COMEX inventories to historic central bank maneuvers, from supply chain breakdowns to a monetary system built on digital sleight of hand, the conditions for a revaluation aren't just forming, they're converging. And when that convergence hits critical mass, when the debt burden becomes unsustainable, when the digital dollar loses trust, when gold is revalued to extinguish the impossible math, silver will ignite. Not because of hype, not because of headlines, but because there will be nowhere else to go. It will be the last honest asset standing. In a world awash in counterparty risk, silver offers none. In a system obsessed with surveillance and control, silver offers freedom. And in a time when trust is evaporating, silver offers truth. A tangible, verifiable, globally recognized unit of value. Whether you're protecting savings, hedging against inflation, or preparing for what comes after the Great Reset, silver isn't just smart, it's essential. The reset isn't a theory, it's unfolding, and silver isn't reacting to it, it's defining it.
of these desperate policymakers who were drunk driving for years have now crashed the currency into a wall and are blaming it on somebody else. That's classic political lack of accountability. But look at a graph of any currency versus gold in the last 50 years. Look at that ice cube melting. Look at the debt levels in the US and in the world. Since 1997, when I came out of grad school, global debt was 30 trillion. Today it's 300 trillion. That's an extraordinary movement in debt. Understand that as debt goes up, currencies go down. So you look at what, look what your dollar has done versus gold in the last 50 years. Look what debt has done in the last 30 years. Look what your currency is doing. These are objective things you can look at without reading any history books. Just look at these simple indicators of what has happened to the debt levels and what has happened to your currency in terms of its purchasing power, not relative to the yen or the peso, but in the US, what can it buy? So understand debt. Understand the debasement of your currency, and frankly, understand what inflation is. Inflation is just a term of art that we wankers throw around to look like we know Wall Street lingo. What you need to know about inflation is it's an invisible tax. You pay income tax, you pay sales tax, you also pay an inflation tax. So when your dollar is worth 10% less every 2 or 3 years, or 20% less every 4 years, and your wages aren't going up with that, that's simple math. You are losing money through the invisible tax of inflation. And here's the thing that you need to check on your own. The scale used to measure inflation is as bogus as a 42nd Street Rolex. I've said this many times. It is an open lie. It is an open secret. So you're not even being told the truth about what inflation is doing to you. You feel it when you go to Walmart. You feel it when you buy a car. A Ford 150 goes over $100,000 right now. That's ridiculous. Your wages came and buy a pickup truck in America, the American dream. It's a Range Rover price for a pickup truck now. Again, you feel the inflation. You feel it at the GW Bridge coming out of New York. You feel it in the costs of education and healthcare. But they're telling you, your government is telling you, now we're in the 2 to 3% range. That's just absolutely not true. So again, gold bug or not, please look at that. Look at it honestly. Look at what inflation is doing to you. You feel it. And by the way, when you go to your investment advisor, whether you're a millionaire or whether you're a teacher with a 401k, ask them what yield they're getting on their bond portfolio. And then ask them, if my yield is 3 to 4%, but actual inflation that I've just figured out what it means is 10%, that means aren't I losing 6% just on my bond investments? So ask about that, and ask your advisor, even if you're going to Goldman Sachs or JP Morgan or Citigroup or Morgan Stanley, the big and the best, talk to your private wealth manager and say, why is it for the last 25 years you haven't given me any gold allocations? Why did you downplay gold as a pawn shop asset that was too volatile when it's outperformed the S&P, when it's given 11 times its value in the last 25 years versus a bubble that's given me 7 times value? But the experts in the room were purposely telling you not to think about gold. So you got to ask these questions. They're math questions. They're quantifiable questions. The history gets a little wonkier, and then it gets political, and then your biases left or right can come in. But math is a stubborn thing. It's facts. Look at those facts, and then decide from yourself what opinion you want to have with those facts. I've been doing this for 25 years, and many of my clients are bankers and hedge fund managers who don't talk about gold out loud, but they're buying millions of dollars worth of it every day because you have